we are doing a webinar on Bollinger Bands, on Keltner Bands, and on how to use them together. First off, the Bollinger Bands are like a volatility envelope. They're going to like catch the high and low end of volatility. You know, on those big wicks on the morning runs, often those will wick down off of Bollinger Bands because essentially you have the middle line, which is just a 20 moving average on any time frame. But then the upper and lower bands are plus or minus 2 standard deviations of a move from the midpoint. So just mathematically, it makes a very logical sense that on any impulse move, you'll see sellers kind of starting to step in there on any given time frame, especially higher time frames. Because of that, they're very useful for tracking intraday price action. They're very good for sell signals. So those are the components of a Bollinger Band and kind of what they represent. And their purpose is, like I said, just measuring that price volatility relative to recent trading. The next component is a Keltner channel, which is slightly different. So this is going to be a 20 period EMA for the middle, and the upper and lower lines are going to be 1.5 times the average true range of a stock. Both of these indicators look back a certain distance. I think the default is 30 days. I'm not 100% sure on that. It might be 20. Essentially, it takes the average of either the standard deviation moves from the price or the average true range moves of the price on each of those days that it's looking back. And then, it takes an average of all of those and uses that to draw your lines here. The important thing to know is that Bollinger Bands, they move more. They're more sensitive than the Keltner channels. So when you have Bollinger Bands squeezing inside the Keltner channels, it's representing that on the shorter time frame, most recently, price is getting significantly tighter than it was in the majority of the look back period of those 30 days. So essentially, we're isolating like a day to a week where we can very likely get a big expansion in that volatility. This is really useful for all types of trading, but I think especially for swing trading and for options traders, because these tight setups allow you to have very minimal risk, right? Because your stop losses can be much smaller, but your projected targets can be quite large because you're looking for that expansion. In general, we always look for volatility just because we would like when things that we're in move big, but if we're able to get them in a low volatility period, then you get that volatility expansion working for you.